Did you know that barely 1 in 4 UK adults own stocks? Or that over half of the nation's wealth is in the hands of the richest 10%? The FTSE 100 hasn't even doubled in the past 5 years. And while it can feel like everyone else is getting rich, the truth is far more uneven. Much of the real wealth building in Britain happens quietly, far from the public eye. For the average Brit, investing often starts small, if at all. Around 26% of UK adults invest directly in stocks and shares, roughly 14 million people. A larger 54% have some form of investment, but that could mean anything from a workplace pension to a bit of cryptocurrency. The most popular asset by far is still cash savings, which make up about 15% of UK household assets, compared to just over 8% held in equities and mutual funds. And the wealth gap is stark. The richest 10% own well over half the country's wealth, while the bottom half hold less than 5%. For many, caution comes from history: the dot-com crash, the 2008 financial crisis, or the recent inflation spike. These events reinforce the idea that the stock market is risky, best left to finance people. But that mindset has a cost. Holding too much in cash might feel safe, yet over a decade of inflation can quietly erode thousands from your savings. Those who do start investing often choose low-effort, steady options like stocks and shares ISAs or global tracker funds. Only about 16% of Brits actually hold a stocks and shares ISA, even though the difference in returns can be dramatic. For example, £10,000 left in a typical savings account might shrink to £8,700 in today's money over a decade due to inflation. The same £10,000 in a global equity fund, ISA, could grow to around £12,200. The FTSE 100 itself has averaged roughly 5.6% annual growth over the last 5 years, lagging far behind the S&P 500 12.5%. But over a 20-year period, with dividends included, the FTSE still manages an average of around 6.3% per year, slow and steady, with dividends making up nearly half of the total return. Long-term investors talk so much about reinvesting dividends because it quietly compounds into something powerful. Diversifying beyond the UK into global funds, bonds, and even property trusts helps smooth out the bumps. It's like building a football squad. You can't win with just strikers. You need defenders and a goalkeeper too. And in investing terms, bonds and alternative assets play those defensive roles. The wealthy, of course, play a different game. Their portfolios are multi-asset and multi-strategy. They don't just buy index funds and wait. They selectively pick stocks, hunt for undervalued companies, and focus on generating steady income through dividends. Many gain access to investments most people can't touch: hedge funds, private equity deals, specialized trusts, all designed to keep capital compounding year after year. At the very top, family offices manage these fortunes like private businesses, with teams of professionals handling tax planning, estate structuring, and exclusive opportunities. Take Sir Jim Ratcliffe, for example, founder of the industrial giant Ineos, and one of Britain's richest individuals. His fortune wasn't built by buying index funds or following market trends. It came from spotting overlooked opportunities. Ratcliffe acquired struggling chemical businesses from major corporations, restructured them, and turned them highly profitable. Over time, he expanded into sports teams, Formula One, and even launched a 4x4 vehicle to rival the Land Rover Defender. For the wealthy, investing often means taking calculated control of the asset itself, not just owning shares from a distance. Tax efficiency plays a huge role in building and keeping wealth in the UK. ISAs and pensions remain the most powerful legal shelters, offering tax-free growth and, in the case of pensions, tax relief on contributions. Yet uptake is surprisingly low, with many people not using their full annual allowance. The wealthy also use techniques like tax loss harvesting or donating appreciated shares directly to charities to avoid capital gains tax while claiming deductions. British high net worth individuals often use secured loans, trusts, and family investment companies to minimize realized gains and pass wealth to the next generation with minimal tax friction. Michael Platt, co-founder of Bluecrest Capital, is another example of a different playing field. Platt started young, investing £500 as a teenager, but went on to build one of Europe's most successful hedge funds. Bluecrest became known for agility, shifting capital between strategies quickly, hiring top trading talent, and embracing sophisticated risk management tools. While retail investors debate one stock, firms like Bluecrest run dozens of complex positions simultaneously across multiple markets and asset classes. It's less about beating the market and more about controlling risk and exploiting niche opportunities at scale. For ordinary investors, that world might seem distant, but some principles can still be applied. Building wealth isn't about chasing exotic opportunities. It's about steadily improving your position year after year. That could mean using your ISA allowance, diversifying internationally, or automating monthly investments so you don't second-guess yourself during market swings. While some wealthy investors thrive in high volatility environments, many ordinary investors panic in those same conditions. The difference often comes down to preparation and mindset. The wealthy treat downturns as opportunities, a chance to buy quality assets at a discount. Retail investors often sell out of fear, locking in losses. The wealthy aren't fearless. They've simply planned for these moments and have the liquidity to act. The market rewards patience, but it also rewards readiness. Having cash set aside to invest during downturns is as much a strategy as deciding what to buy. It's a habit that scales from a 500-pound emergency fund all the way up to a billionaire's war chest. If there's a lesson here, it's that you don't have to copy every billionaire move to grow your wealth. Start with an ISA, keep costs low, stay diversified, and let time do the work. For most people, the game is steady accumulation, not flashy wins. Understanding how wealth is built and taxed already puts you ahead of many. So whether you're starting with 50 pounds a month or a six-figure sum, the rules are the same. Patience, discipline, and smart tax use beat impulse every time. The sooner you start, the sooner compounding works for you. And that's the one advantage no billionaire can buy back. Thanks for watching this video.